Welcome to the State of Pre-Seed with Kate McAndrew and our live investor AMA. I think she needs no introduction. Kate McAndrew, she's the co-founder and general partner of Baukunst, $100 million pre-seed fund, backs companies at the intersection of technology and design. And she has been in this business for over a decade. She is known for her high conviction founder first approach and her ability to identify category defining talent at the earliest stages. As someone who's also a fan of Kate's and her content, it is very refreshing to see a woman in this space take big swings on early stage founders, especially in this environment. Before launching Baukunst, she spent 8 years at Bolt, where she helped shape one of the industry's first dedicated pre-seed programs. Kate is also an active voice in the early stage ecosystem, speaking frequently on founder readiness, product craft, and how to build enduring companies from 0 to 1. She's also a mom and a dancer and a San Francisco native. Without further ado, let's get into some questions on the state of pre-seed. First question for you, Kate, is you're one of the few investors running a dedicated $100 million pre-seed fund in a market where AI is compressing the time between idea and traction and disrupting the cost to build very significantly. It costs very little to build technology now. It's not 100% there, as we know with AI, but it costs much less. How is your bar for what counts as pre-seed raised in the past 18 months? How are you viewing pre-seed founders now?
So I think that there's a lot in there. Cost to build is changing. When I got started, I wrote my first check in 2012. And at that time, people still had to buy servers, right? AWS wasn't really a thing. And then seed investing was invented when all of a sudden you didn't have to buy servers and you could just plug into AWS. And oh my God, it became so much cheaper. And that's when the whole seed asset class and AI and the leverage that we're getting on engineering is another step on the continuum of making it more accessible to build. We've had other steps in that, like Shopify onboarded all of these, the ability to do e-commerce more easily. So I think lots of things about building a company are still hard and expensive and time consuming, right? And it might be cheaper to write code, but it might not be to sell, right? And so the thing is that there is a lot of leverage from AI. We're in a little bit of a K-shaped market where we have some people who are raising massive rounds, $100 million pre-seed rounds or seed rounds, very capital intensive to build. And then we have the other that are less capital intensive to build. So all that is to say, we exist within a much broader technological context and a much broader enablement context. Ultimately, at the end of the day, the job of a company is hopefully to solve a problem for someone, whether that's a consumer or a business or a consumer sitting within a business. That's really the job of the company. And I think that sometimes can get lost. And my belief is that ultimately what pre-seed is about is partnering with that person from the beginning to go on that journey together. And I actually still believe that people are really critical to that. And people have mortgages to pay and preschools to pay and daycares to pay. And that those costs exist. The durability of pre-seed is actually really unquestionable. And I think people have always needed, will always need some money to get going, to dedicate themselves, their time, their spirit to what is a huge project that isn't just building technology, but it's building a business, which, as we know, the technology is only one piece of what it takes to build the whole business. So I think that I continue to try to catch people at that early stage when they are just getting started, what people are able to prototype, what people are able to do, the proof points have become more and more accessible, which I love, right? So you used to hire a dev shop or have to find someone technical to even get something that you can touch. Now you can at least give people a sense. But I think for me, I don't expect people to be further along in order to unlock pre-seed. I'm not expecting that they're generating revenue. I'm not expecting that they have met what would have been traditional seed stage milestones. But I hope that they're availing themselves of all of the tools that are out there in order to communicate what they want to build. It's actually just easier to demonstrate what you want to do. I'm investing just as early as I always have been, but what people are able to show me is often much more mature than what they would have 10 years ago.
It used to be that you would have to raise to build that prototype, but now you can show it to investors or potential investors and build that story before. And so I'm seeing a lot of investors that are like, show me clients, customers, and revenue, which to me, there's no perfect definition of pre-seed, but to me, that's how I've seen it shift in the circles that I'm in, are people have a higher bar for what pre-seed means these days.
I think the truth is that people just use these words really differently. It's hard to know what people mean when they say pre-seed. To me, it's really about the very beginning. I think lots of people are doing seed deals in companies with no revenue. Just because they're saying doesn't mean that they would say that same thing to something else, someone else. It might just mean I don't have enough conviction to back you yet, which is often what they're saying. How close are you to this investor's idea of their ideal archetype? That will give you a sense of how much traction you think you're going to have. If you're spinning out of one of the major AI labs, no one's going to be asking you for revenue traction, right?
So, what are your thoughts on seedstropping? And if the concept really catches, how might the VC ecosystem change? And for those of you guys who aren't familiar with seedstropping, it's a newer word in the zeitgeist of fundraising. Zapier is the poster child for this. I think they raised $1.4 million to get to profitability, and that's it. And they say they're never raising again.
So I personally love seed strapping. I think it's fantastic, but it's really not for everybody. And you need to have a lot of clarity around if seed strapping is going to work for your investor. And as an investor, you have to a lot of clarity around, will seed strapping work for your LPs or our investors? And so generally speaking, people think of bootstrapping as being great for maintaining ownership, but probably not possible to grow as quickly or get as big as if you took on investment. Obviously, VC backed, the typical cycle is that every 18 to 24 months, you're raising another round of capital to further invest in customer acquisition and technology. And that's allowing you to grow more quickly and build more deeply so that you're building really big enterprise value and getting into that billion, $2 billion, $10 billion plus kind of range, which is really hard to do without outside capital. Seed strapping is in the middle. So the idea with seed strapping is that you raise $1, $2, $3 million and you never raise again, or you're able to get profitable and choose when you want to raise to invest in growth. And I think the thing that we've seen is that today in an AI native world, you're able to build more leanly, which makes it easier on a couple $1 million to invest in your technology, to invest in your team, and to get profitable because you're just burning less capital in order to build the business. And for us, we think this is fabulous because when we think about our exit, our goal is to return our whole fund. So if you have a $100 million fund, we want every investment that we make to be a shot on goal to return their fund. So what contributes to that? It's the amount that you sell the business for or IPO for, and the dilution that we've taken along the way. So it's your ownership, right? And it's not just your ownership at entry, it's your ownership at exit. So for us, if we can pre-seed a company or seed a company, and that company can get profitable on the money and be growing at a quick pace and be going after a massive market opportunity, and we don't have to take on more dilution, like we think that's great. The trick for us is we have to be clear that we have the same ultimate upside in mind. Because if the founder still wants to sell for $100 million total, that's not big enough for us, for our math. And so we have to make sure that the market opportunity is big enough that you can still get to a $1 to $2 billion. And we have to make sure that the founders want to take it there, right? That's the journey that they want to go on. I think the thing that's interesting about the VC ecosystem is, generally speaking, when that VC-backed company is raising every 18 to 24 months, the VC gets to mark up their deal to whatever price that latest round investor paid. So if Andreessen decides that one of my companies is worth 500 million, I get to tell my investors that company's now worth 500 million, no matter how much revenue they're doing. Our investors will market, we will market to what that follow-on investor does. If you don't do that, if you don't have those outside events that value the business, then you as the VC have to independently report what you believe the value is, and you have to explain that to the auditors. You need to be financially strong in order to do that. You need to be experienced in order to do that. You have to come up with a methodology around how you're going to value things. And you have to make sure that your LPs are on board for you to value companies that way. And so it is the kind of work that I think it's very difficult for folks who are not experienced investors or don't have that kind of rich operating experience to be able to do. You're taking on a mountain to climb. But I think it's actually a really interesting part of the business to be in. It looks a lot more like traditional venture when venture started out than where venture is today with kind of the mega funds. So there's a lot of things moving, but to me, it's one of the most exciting opportunities is to get to partner with people really early on to build profitable businesses where they're in control of when they raise and go after these big market opportunities without being beholden to funds that increasingly want to deploy massive amounts of money into these businesses.
Right.
So I'm a big fan of this, but I know that lots of investors aren't. It's really important to be aligned with your investors around expectations and all of that before you do a deal.
Okay, let's move on to the next one. So you back a lot of founders who are domain experts entering a space for the first time. So how much does built-in distribution factor into your conviction at pre-seed? When there's almost no product proof yet, how are you evaluating the value of an audience in this market?
So I think that distribution has never been hotter. Everyone is talking about the advantage of distribution and how if you make it easier for people to build stuff and build something and then somebody can copy it in a weekend, right? Building great product is a much less of a moat than it was 10 years ago. And so having distribution and an advantage on distribution is, I think, just critical today. And if you don't have it, you're going to have to talk about how you're going to get it. And this is true for both B2B companies and B2C companies. We recently made a pre-seed investment in a company in the manufacturing space. They were here just meeting with customers. And one of the things we looked at was, who are they meeting with, right? Because if these founders are getting meetings with the exact right person at Tesla, at Rivian, this is in the automotive space, like they have an ability because of their network, because of the decade plus careers that they had at Tesla and Rivian, that they're going to have an advantage selling in. That is going to give them the chance to get great design partners, to get into early revenue with marquee customers, to then onboard more customers. So that can be an advantage based on your professional experience, especially in the enterprise. I think the thing that there's a bit of a trend of venture studios starting companies, having big creators take big equity slugs and then hiring in CEOs, that I'm pretty worried about. I still believe that the founding team, the people who are waking up every day thinking about something and really building the business, I think they should own it. And really interested and excited about some of the things that Cherub is doing around how creators can invest and how creators can participate in the value that they're creating by bringing their distribution, while also still keeping the heart and soul of the business with the founders who are all day, every day operating those businesses. But distribution is critical and customer acquisition is expensive. So having built-in distribution, having an advantage with distribution, or explaining how you're going to get an advantage is really important.
Agreed. And it's all over my feed. And especially this week, I feel like it hit an inflection point where everybody is talking about this. And I feel really excited to be with Cherub at the forefront of this. In a previous webinar, you covered pitch prep and approaching investors. Following up on that, after a founder sends their deck, what does a thoughtful follow-up look like from your perspective?
What, like you sent it cold or you got a connection and sent the deck? Can you clarify?
Send it cold, I think.
So the first thing I'll say is try not to do that. And if you sent it cold, I probably wouldn't follow up. I would try to figure out, is there someone that I can get to put this in this investor's inbox in a warm way? I'll give you an example. So we did a webinar Q4 December, I think, and we had people attend the webinar like this. They cold pitched me afterwards, but I missed it. And they ended up then getting a warm intro through someone in our collective, and we ended up investing. And I didn't know they had been on the webinar, but it was much better for them to find a way in through kind of the social proof of their network than to follow up on the cold inbound, because cold inbound is always going to be the bottom of the barrel, right? It's where the worst founders, and I'm not saying people here who are doing cold inbound are bad, but you are in a basket of shit. Okay? Horrible spam, rude people, AI, that inbox, is she ugly? Okay. And so if you're in that inbox, you have to understand the pool that you're swimming in is poison. So the more that if you're not getting a response there, and I go through the cold inbound or someone sends me things, and sometimes I will take those pitches, but you're starting from a disadvantage. I would say if someone doesn't respond to your cold inbound, really try to find another way into them. And this has now happened twice. We had another investment that we've made that found me through social, pitched cold. I didn't see it. And then she got an intro, and I was like, oh, actually, this is interesting. And we ended up investing. And again, I didn't know that when I talked to her, but try to figure out how to get out of the cold inbound pool. And part of what you have to know, people who do cold inbound, they're running sales software in the background that's following up automatically, and it just pisses me off. When I started, I looked at every pitch and I was able to do 15-minute calls with everybody who was pitching cold because there was no software automation. But because of automations and AI, the funnel is so big that it's brought the quality down, which is actually worse for people who are less networked. I would not follow up. I would find another way in if you think you're really a fit. I will say one other thing you can do if you don't have a way in, try them. If they're on LinkedIn, try a LinkedIn message, or if they're on Instagram, try a DM, a different channel, because those people are just on different channels in different ways, and you know what filters they have on. So if you don't have a warm way in, like try a different channel.
Can you dive a little more into how big of a social media following you look for and what type of engagement?
I don't really care about your social media following at all, unless that's something that you think is going to be material to your business. I'm going to win because I'm a creator, and then your metrics better be off the chain, and you better have hundreds of thousands of followers and be able to show me that you're a rapidly engaged community. That's one piece of the thing that I'm looking for. We had a company pitch us. They had 2 million followers. I've had a couple of people pitch me with 2 million followers, 5 million followers, and they're like, we're going to convert this into a business. And I'm like, tell me about the business. They had big followings, but the businesses didn't totally make sense to me. So it's not about the size of the following, it's about the business. And if that following is a piece of how you're going to succeed, great. That can be one piece, but it's never the whole picture.
We have a live deployed product with early store pilots, but we haven't formalized revenue yet. Is that a stage that you've worked with before, or do you prefer to come in even earlier?
So we're pretty flexible. Pre-seed is a phase, not a stage. Like, I think it was actually my friend Charles Hudson who coined that like many years ago, where it was like, really, there's just this era that you're in where you're figuring it out, right? You have an idea and a plan, maybe early deployments. you're testing things. And that whole phase to me is pre-seed. That's totally possible to look at things. I think for us, where it becomes tricky is if you've already raised $1 million or $2 million to get there, and you're expecting us to pay a seed valuation, even if we like the business and from a stage perspective, we still consider you pre-seed, we might just be priced out. So two aspects to what defines a stage, right? You have what's the maturity of the company, and you also have what are the check size and valuation dynamics. The VC firm, we have to have an opinion about where we fit into the market, both in terms of the kind of companies that we want to invest in and where we can help, and what our check size and ownership targets are, because that's the story that we tell our LPs, and that's really what our fund model is built on. I think that if the valuation expectations and the round size expectations are a fit for pre-seed, then that traction does not at all preclude you from pitching an investor like me.
If you were going to raise capital for your first fund today, what would be your thesis for the LPs? Would you stick with the same approach, or do you think the rise of AI has fundamentally changed how you position it?
If I were to start a fund today, I honestly think that what we're doing is, I would call it like a classic. Basically, what we're doing today was what it was called Series A in the 90s. And yeah, it was called seed, and now it's called pre-seed. And I think there will always be a business of giving people their first chunk of change to go take the risk and build something big and to help them doing it. I think the way that you sell it is different, and the dynamics that you have to explain to LPs is different. So I would probably pitch it a little bit different, but ultimately I wouldn't change anything about our business model.
Are there businesses you believe in that you know your fund won't invest in because their exit math works for the founder but not your LPs? And when that happens, do you angel invest personally?
It happens all the time. That is one of the hardest things, is like having amazing people who are building things and friends, and just not being able to get there from the fund perspective. I personally don't angel invest. My money is tied up in this segment of the asset class. If you look at like my personal investment portfolio, any person with half a brain would say, wow, you're really overweighted in the private markets. So like it doesn't really make more sense for me to do more angel investing. So I don't angel invest, in part for that reason, and in part because I think it becomes very murky and tricky when you're trying to make a decision. Is this a fund deal or is this a personal deal?
Okay. At pre-seed, when metrics are mostly noise, what tells you a founder is actually building something that will hold its shape in the real world versus something that only works in early storytelling?
It's a great question. One of the things that we look at is this a product or is this a feature of a product? Right? And when you're investing, you want to make sure that you're investing in a business that is going to be the full product. That's how it gets big. You can have something that's a feature, but it's likely going to get acquired early or get bolted onto something or get copied. So you might have something that's cool and that people love and are using, but is it durable? Right? Is it a big enough idea? Is there durability in it? Other things that we look at are underlying metrics around usage behavior and repeat behavior, and the favorite question of, if I took this away from the user, how much pain would they experience?
Yeah.
So there are some sort of qualitative things like that you can get into. But ultimately, I think we're just on a journey of trust with the founders and digging into their insights around the customers and how we think that product is going to wrap up the bigger business opportunity and be able to get significant LTV in the first year. So I think that like it's a little bit of feeling it out and really looking not just at the product, but at the underlying business and market opportunity and comps and like how we think that things are going to evolve in the 5, 10 years 15 years that it'll take to build something really big.
Okay. Are you investing in software AI startups, or do you also fund consumer hardware products?
So I actually started out in hardware investing. So Bolt was a hardware fund, and I did hardware for 8 years. I and also built the whole CPG thesis there. We were the first check into Tonal, if folks remember Tonal or Phi, the like smart dog collar. So I really started out in deep tech. We also invested in Boom, by the way, co-investors
Oh,
there.
yeah.
Desktop Metal, which is like desktop 3D printing company that exited for $1 billion. So I started out in physical products and deep tech and then built our CPG thesis. We led the pre-seed in Bobby Baby, where I'm still on the board, and some other like Wild Green, which just they're a seeds dropped company. They just crossed. I don't know if I can say what their revenue is, but very high, very high. And so yeah, I do consumer hardware. And I love hardware, and I've been doing hardware for a long time. I also have a lot of scars of hardware. And I think a lot of people doing hardware right now are discovering it for the first time. And so I have a lot of both respect for hardware and skepticism around what it takes to win with hardware, but I absolutely will look at that space.
Got it. This is a selfish question. Do you think that most venture dollars are going to jump into hardware now that we're in the age of AI?
No.
No. People, okay, interesting.
I think that there's a lot of unnatural things happening in the ecosystem right now that don't really make logical sense. There's a lot of money going into hardware. There's a lot of money going into defense and hardware in the defense context. And there's robotics. There's a lot of money going in there. And I think a lot of it will be lost. And there will also be like products that win, right? And that's what happens. You get this overfunded landscape. It gets competitive, so prices go up. People think, oh, this thing's hot. Oh, they're doing this, it must be successful. More people fund things that are like that, and ultimately you get a couple of winners out of that. Sometimes those winners don't come to fruition for a long time. Look at Waymo. People
Hardware.
were all about self-driving in the 20 teens. It was all about self-driving, right? And only now are we seeing the fruits of that come to be, and a lot of money was lost along the way. If you are sitting within Tesla or Apple or Rivian, you have a 10-year advantage on the technology tools that are being used to design, ship, and deploy hardware. I think that as a startup, you have to think about, sure, where is the market going to move, but also who's well suited to win.
How do investors view solo technical founders who are building in a domain where they don't have direct hands-on experience? Is a strong software engineering background enough, or do investors expect deep domain expertise as well?
So my perspective, so first of all, I have invested in a number of solo founders. I will say this, if you can find the yin to your yang, the hacker to your hustler, the hustler to your hacker, that is the best situation. That again and again, like that is the thing that tends to work, right? If you like, are there exceptions? Of course, there are exceptions to every rule. I think if you have someone who can hustle and sell and knows that industry inside and out, and you have someone who can build and rapidly deploy a product, that's the winning combination. If you don't have that person or don't want that person, my question is why not? Like, why do you think that you're going to move faster and do better without that person? Oftentimes, when I ask that question, the answer is about fear. I don't know that person. I don't know if I can trust that person. I don't want to give them all that equity. That is your own battle with control. That is your own battle with the unknown. And that's a battle you're going to have to fight, right? And you can choose not to fight it, but people are going to discount you for it. So that's just the reality. And so I think the other piece that people really underestimate is it's very different to have a co-founder than to have employees. You have to hold your shit together for your employees. You don't get to fall apart with your employees. When you're personally lending money to the company to make payroll, you don't tell your employees, right? The co-founder is someone you're in the foxhole with. And whether that person is technical or non-technical, they play a role of helping you carry the stress and carry the full weight of what it is to build that business. And I think that's the piece that investors know because we watch this journey again and again and again, and we know how hard it is and we see how hard it is. And when people are stuck in the what I do all day tippy typing and what the other person does tippy tapping, I'm not saying that's what this person is saying, but like when you're stuck in that mode, you're really not realizing the levels of hard that the journey you're about to go on is going to be, right? And like I believe in solo founders. I also really believe in teams. I'm not a solo GP for a reason. I have three co-founders. I trust them more than anyone in the world. These are like my people. I would never do this without them. And you do need to have that trust. And like I fully trust I'm not in the finance meetings, right? My partners are not in the marketing meetings. We run front of house and back of house as teams of two. And we're able to trust each other and build a better business, a bigger business, a more robust business, a more resilient business because of that. I also prefer the hacker hustler combo when you can find it. You can move more quickly in different areas of the business. You can shoulder the weight together. So I'm a big fan of that.
Yeah. That was a fantastic answer. Thank you for that. I think that's a perfect place to end today. Thank you so much, Kate, for your contribution both online and to this webinar. If you are interested in inviting creators on your cap table for some of that distribution we've been talking about in this new landscape, we have something coming soon in just a couple of months. So if you go to investwithcherub.com/4-founders, you can sign up for our wait list and you'll be hearing from me in the coming months with more information on that. So exciting things in the pipeline and very excited to share them with our community here. So again, thank you so much, Kate, for being here. I hope you guys all got something out of it. Thanks so much,
Thank
everybody.
you.